want to learn how to manage your own investments? Are you ready to stop paying investment management fees and start building wealth? The DIY Investing Podcast is dedicated to providing you with the knowledge, skills, and resources you need to be a better investor. Learn how to make investments through the use of fundamental analysis, mental models, and business management insights. Now, here's your host, value investing expert, Trey Henninger.
Hello and welcome to episode 25 of the DIY Investing Podcast. My name is Trey Henninger and I'm your host. In today's episode, I will be discussing discounted cash flow analysis, or DCF. Specifically, I'll be discussing long-term growth rate assumptions and how they are used in DCFs. So I'll talk about what they are, how you can make them, and then how to calibrate your long-term growth rate assumptions based upon management's regulatory required disclosures. A brief introduction for those new. This is a listener-supported podcast. If you'd like to support this podcast and help me to continue creating great investment content, please consider becoming a patron at diyinvesting.org/patron. My goal is to keep this podcast free of outside advertisements, and in order to do that, I've decided upon a model that skips the middleman and allows me to receive support directly from you, the listener. My goal is always to provide you with value, and so I have a membership program set up that provides you rewards based upon those who become patrons of the show. Those rewards are specifically targeted at investors. I have insight into my personal investing process, where you'll learn the companies that I am buying, the companies that I am doing my investment analysis on, learn about high quality companies, their intrinsic values, and what I think about them as I do my research. If you can't support me financially at this time, I would really appreciate a review and rating in your podcast player. If you open up your podcast player and give me a rating or review, that helps me to grow the show, and I really appreciate your feedback. Thank you. Now let's dive right on in. So, my show outline's pretty simple. As I said in the introduction, I want to cover three main things. What are long-term growth rate assumptions? How do you make long-term growth rate assumptions? And how do you calibrate them based upon management's regulatory disclosures? So first, what is a long-term growth rate assumption? Well, first you have to understand that in discounted cash flow analysis, one of the key variables is what is your growth rate. And in a simplified discounted cash flow analysis, you're really looking at three things: the current earnings, the growth rate of those earnings, and the discount rate. And in the simplified analysis, we're just saying that you're already at a single long-term growth rate, and that growth rate is constant both for this year, next year, and all future years. Therefore, when we think about long-term growth rates, we're really thinking about saturated market growth rates that are the max that a company can be expected to earn over extremely long time frames, because these time frames are going to get built into your valuations. And those valuations are going to change dramatically based upon the assumptions that you use. So it's really important to get them right, but it's also important to understand general bounds that apply for these growth rates. And so when I'm talking about growth rates, what I'm specifically mean is if you're earning $100 per share this year, and what is the earnings per share that you would expect next year? And what is the difference between those put into a percentage? So if you're earning $100 per share this year and you earn $103 per share next year, that's a 3% growth rate. Versus if you earned $105 per share next year, that's a 5% growth rate, because you're going from $100 per share to $105, and that's a 5% gain. Now, what's important to understand is we're not talking simply about what is a year-over-year growth rate, like what are we earning this year versus last year. We're really talking about what are the growth rates going to be over the next decade, 2 decades, 3 decades. And we're thinking long-term. And what this means is that you have to inherently bring your growth rates down. So while it's quite possible that you might grow 10% next year in earnings or 20% next year in earnings, you would never want to use such a high number in a long-term growth rate assumption because you're growing faster than the economy. The economy is not growing 10% a year. So it's impossible to grow faster than the economy over the long term. So you need to make sure that that is one of the bounds that you understand for your growth rate assumptions. And what we're talking about here then kind of leads us into the second part. How do you make good long-term growth rate assumptions? And you really need to begin by thinking about upper bounds, upper limits, and lower bounds or lower limits. And a good upper bound limit is the one that I just stated. So what is the growth rate of the economy? And just like we talked in one of our previous episodes about discount rates, this can be both in nominal or real terms, inflation adjusted or non-inflation adjusted. But really, you need to be very careful when you're talking about inflation adjusted growth rates, because the key goal that I'm saying for a long-term growth rate assumption is that, let's say you want to grow as fast as the economy. And the economy, in this sense, is represented by GDP, a country's gross domestic product, or the world gross domestic product increase. When we're thinking about this number, it's typically treated in nominal terms as far as a growth rate assumption. So is the economy growing at 4%, 5%, 6% per year? And it does not include the effects of inflation in that number. And so let's say the long-term GDP growth rate of the United States is something like 5% per year on a nominal pre-inflation basis. I think this is pretty reasonable. I think it's a fairly accurate estimate over the long term, but of course it's always unpredictable. We can't really say how productivity is going to grow over time, but we do have some idea of demographic growth over time. And really your GDP is growing with a few different things. You have the inflation growth, the demographics, so what's population growth, and productivity growth. So GDP is made up of those three terms. You have population, inflation, and productivity. So when we're talking about a nominal growth rate, we're including all three of those. And what that's really doing is creating a cap on what your long-term growth rate is. And you should be very careful even to assume that you're going to match the long-term growth rate of the economy, because that's quite rare for companies, and it very much depends upon what the company is doing, where it is, how important that industry is to the economy overall. There are great examples historically of the leading companies growing over time, but growing slower than the economy. What that means is that the proportion of their economy affected by that portion of the economy, let's say manufacturing, declines over time. So the percentage of the economy that is driven by manufacturing has fallen in the United States. Not much, but it has fallen. But if you look at, say, another example would be agriculture in the 1900s. Agriculture was a huge percentage of the GDP of the United States, and that has fallen over time. That's not to say that the agricultural industry hasn't grown, but as a percentage of the economy, it has declined, which means that if you were assuming for an agricultural business that they would grow at the pace of the economy, your assumption would have been wrong. So it's just to give you a clear upper bound of what we think growth rates might be. A caveat here, of course, is that you have to be very clear on whether your company is a domestic-only company or an international company, and whether you're using global GDP or national GDP. So one way in which companies can grow temporarily faster than the local GDP is by expanding overseas. And that's what a lot of American companies have done over the last 100 years, is they become international companies and they receive earnings from international economic efforts, international sales, which means that they have been able to outgrow the GDP growth of the United States. This has been very positive for the performance of the United States stock market. But The risk then is you still can't make an assumption that their long-term growth rate will exceed the GDP because they will eventually run into the GDP upper bound of the global economy. Now, because the United States is a fairly large country, it's a well-established high, and a lot of the technological advances have been achieved at the forefront in the United States and other Western countries. You have to be careful because the U.S. growth rate is actually slower than the overall growth rate. So you have China growing in the 6% real GDP range, while the United States is growing in the 2 to 3% real GDP range right now. What that means is that you need to be very careful because international companies might have different growth rates than purely domestic companies. So you need to be clear on what that is and get an idea. But if we're looking at United States companies or we're looking at global companies, I really like the idea of using something like a 5% GDP growth rate on a nominal basis. That's not a real basis, but that's basically if you include inflation, you include productivity, and you include population growth. So it really means that I'm placing an upper bound of 5% on my long-term growth rate assumptions. So if I want to 5, sometimes 6%, it really depends upon how much international we are including and really how we get into that. But in the 5 to 6% range, you're really at your upper bound on long-term growth rates. But again, you just need to make sure for the upper bound that you are very confident if you use that upper bound number that you're going to grow at the rate of the economy. Now let's talk about lower bound. On a nominal basis, your lower bound can be negative. You need to be very careful, of course, in assuming that your company can grow forever. High quality companies ideally can, as long as they're able to maintain their moats, they'll continue to be able to grow. And you would hope that your company can at least grow at the rate of inflation, but that is probably the most important area that you want to determine. The question to ask yourself would include, can my company grow earnings at the rate of inflation, higher or lower? Yes or no? If it can grow it higher, that's good, but you shouldn't assume that a company can outgrow inflation for long periods of time without taking into account the other aspects. So is it growing faster than inflation because it has more people? So are you counting the population growth? Okay, that can be reasonable. Are you counting benefits from productivity growth? Okay, that can be reasonable. That's how you get, if you can assume all of those benefits, the benefit of being able to keep up with inflation, the benefit to be able to serve more people, and the benefit to become more productive, that's how you're able to hit that upper bound for your growth rate. But there's always negative factors on a company's performance. You have to take into account the threat of competition. So if you're assuming a high growth rate, then competition can attack that and really put a negative effect on that. And this is important because when you do long-term discounted cash flow analysis, your growth rate is going to have a massive impact on your final result. And we'll get into an example of that later in the show. And where I reduced the growth rate that I was assuming, and that had a major effect on the intrinsic value for a company of shares that I've been looking at and valuing. So on the lower bound, though, you can't truly take a bound like 0. So while 0% would be a nice thing to have as your lower long-term growth rate, it's probably the one that is most useful for companies that you want to be looking at, but there's certainly companies that might decline forever. But you have to be very careful because it's a very few companies that can have a long-term growth rate of, say, negative 5% and not have that accelerate at some point. So if you're assuming a negative growth rate for long periods of time, while this can be possible, most companies use some form of leverage or operating leverage such that even if the growth rate is negative 5% in year 1 or year 2 or year 3, at some point that 5% turns into a 10%, turns into a 20%, turns into negative 50% until all of a sudden they're losing money and then they might go out of business. So when you're making long-term negative growth rate assumptions, you need to definitely take that as a red flag about whether you should be investing in that company. It's not to say that there isn't value in companies with declining earnings. There absolutely is, and you need to know how to make those assumptions. But I would highly recommend not using a long-term growth rate and to actually do a more detailed intrinsic value analysis where you break it out year by year what you expect earnings to be. So what that means is we're really bracketing our growth rates in what I would say is a 0% nominal range to a 0 to 5%, 0 to 6% nominal range. So let's call it 0 to 6% is our nominal range of where we want our long-term growth rates to be. With the caveats that you have to really think about business quality, you need to think about what countries you're operating in, and how you think the company is going to grow. Is it growing purely from people? Is it growing from gaining market share and that sort of thing? But you have to always remember, I just mentioned market share increases. You can never increase market share forever. If you go from 1% to 15% market share, that's great, but you can't go from 15% to 200%. You're capped at 100%. So you can't use market share gains as part of your long-term growth rate assumptions. You can use it for temporary growth rate assumptions, but your long-term growth rate assumption can only use things that can happen forever. So we have now a boundary of kind of that 0 to 6% range. Now, what sort of things would you look at? So the first thing that I would really look at, or the second thing, because I already talked about the inflation, is do I think that this company or that this part of the economy will continue to be a specific amount of the economy in the future? Do I think that the proportion of earnings, the proportion of income for this portion of the economy is going to maintain itself in the long term? I think it's important to always be a little humble here and say that in almost all cases, or most cases, that's not going to be true. There are certainly parts of our economy that are always going to have value. And whether that be agricultural, feeding people, there's always going to be value for those that can produce food for the population. There's always going to be value for those that provide services to the population. And there's always going to be value for those that provide manufactured goods for the population. The question, though, is you don't know how those are going to change, and you don't know which products and services will actually be produced in the future. So if you're going to assume something like keeping up with the long-term growth rate of the economy, you need to make sure that the type of business you're in is infinitely durable. And this is rare. This is not a common quality. So your average company is not going to be an infinitely durable business. It's not going to be something that's going to always be around forever. These are rare. And one of the examples of something like this is a marketing company. And it's actually one of the ones that I want to talk to you about today in my example. And that's what I'm going to use to lead us into our third part. How do we calibrate our growth rate assumptions based upon management regulatory disclosures? And my example today is Omnicom. Omnicom is an advertising and marketing company, and they are a holding company for ad agencies based in the United States, but operating globally. And what I want to talk about today is the work that I've done in building out an intrinsic value analysis for Omnicom. You can read the intrinsic value report that I have created for Omnicom on my website at diyinvesting.org/Omnicom value report. Or you can also find a link to it in the show notes. This is, of course, a patron-only benefit for those contributing at least $10 a month. And you'll be able to get access to my intrinsic value analysis where I break down the exact price that I believe Omnicom is worth and the intrinsic value that I have assigned to that. I also show the entire method where I've come up with these numbers, all of my assumptions, everything I have in the business. And this is just one example of the benefits of patrons of this show. So I highly encourage you to check it out. The link to that will be in the show notes. But a little insight to what I've done, because this is my example. So for the longest time, that's not the longest time, but over the past year or so, I've been assuming that Omnicom will have a 5% annual growth rate in their earnings. Now they are already a large company, and so I'm not making any sort of short-term growth rate assumptions for Omnicom. I'm just only assuming long-term growth rate assumptions. So this is a perfect example for the type of company we would look at for the topic of this show. But again, think about what I said earlier. I was assuming a 5% long-term growth rate. That growth rate is based upon them being able to match and maintain market share in their industry, not grow it, but that their industry would also maintain the market share of the economy, because advertising and marketing is a constant need and will always be needed in the future. At least that's the theory. Over the last year or so, as I've been studying Omnicom, I've read a couple of their annual reports. I've noticed that Omnicom hasn't been growing at a 5% rate. Now, if you listen to their earnings calls and you listen to the management, they'll talk about how there's a lot of temporary problems in the company and this is not a long-term issue, and that they will increase their growth rate back to what you would expect them to have done over the last 10 years. But it was important to calibrate my assumption and make sure that 5% is the right number, because again, you need to make sure that if you're going to assume a number like matching nominal growth of the economy, you need to double check it with as much as you can. So what did I do? I reached out and I read the management required regulatory disclosures, which is the 10K report published in the United States with the SEC. So you can find it in the Edgar system, and I'll have a link to the Omnicom 10K in the show notes, where it will show the information I'm talking about. And what you'll find is on page 11, they have 10 and 11, they have a discussion of their critical accounting policies. And this is where, in the 10K, the company can report on different aspects of their accounting that is valuable and important for readers. Now, this is a portion of the 10K which is that every company reports, and you will find this information for every public United States company available for free on the SEC website. So I highly encourage you to use this tool in the future for your own investments. But what they have under this critical accounting policies is a section on acquisitions and goodwill. And what I want to focus on is specifically goodwill and their goodwill impairment review, estimates and assumptions. So every year in the United States, public companies are required to do an annual review for goodwill impairment. And goodwill is basically the difference between an acquisition, the money paid during an acquisition, and the tangible assets on the book of the company that a company is acquiring. So Omnicom is a company that makes acquisitions over time. They have continued to make acquisitions, and when they do so, they add goodwill to their balance sheet. Because of that, they're required to make these annual analysis of the value of the goodwill. And if it needs to be impaired, which is marked down because it's lower value than what's actually shown on the books. What this means is management has to make certain assumptions in the growth rates of their company. Because when we value companies, we have to use growth rates. And when the management values a company, they have to use a growth rate. Well, what I noticed in the 2018 and the 2017 annual reports, which are these 10Ks that I'm talking about, the long-term growth rate assumed by management is 4%, not 5%. And I noticed this a little while ago, and I've been thinking about it for the last few months, and I finally decided that I probably should go ahead and reduce my growth rate assumption from 5% to 4%. Now, I still think it's possible that the long-term growth rate for Omnicom exceeds 4% because I tend to trust my analysis. And I believe that Omnicom is in a very good position, that they're going to be able to grow strongly, and that they are one of the best companies in their industry. However, when you're doing intrinsic value analysis, especially those based upon discounted cash flows, you need to be conservative in your numbers. And so I decided to make the change to reduce the intrinsic value of Omnicom by reducing the long-term growth rate that I assume from 5% to 4%. So how did that affect the intrinsic value? Now, I'm not going to share the specific intrinsic value that I calculated on this show. If you want that information, you need to be a patron of the show. And again, those links are in the show notes, or you can find out more information at DIYinvesting.org/patron. But what I will share is the difference that it made in the intrinsic value by going from 5% to 4%. What you'll see is the intrinsic value dropped by 13% for the company, simply because I changed the long-term growth rate from 5% to 4%. So that means that the price at which I was willing to pay is now 13% lower. And the point at which I expect to earn 10% annual returns is 13% lower than it used to be, which is a huge impact because that's somewhere in the range about half of the margin of safety that I would have said might be available in this company for shareholders. So it's really important that I get these numbers right, and it can drastically affect the ability for me to buy into the stock and the ability for me to be safe with my margin of safety in the stock. And what I mean by ability of me to buy into the stock is you don't want to be too conservative in all of your assumptions because it will limit your possible buy list of companies. If you're extremely conservative, every time you look at a company, you're never going to have any options to buy stocks because everything's going to look too expensive. So it's really important to get these numbers right. But it's always a safe assumption when you can calibrate your assumptions based upon management's opinion of the business. So the management of Omnicom and the management of many companies has worked at those companies and knows more about those companies than you do. Now, that's not always true, but if you're looking at a company for the first time and you've spent 5 hours, 10 hours, 20 hours looking at a company, and you compare that to someone who has spent 15 years working at a company or 30 years working at a company, you better assume that they have a better understanding of the business than you do. So if they have a long-term growth rate that's higher than yours, I'm not saying you adjust to that, but you should take it into account. And if they have a long-term growth rate that's lower than yours, you should definitely consider that because it's always better to be conservative if management is targeting a number that's lower than what you are targeting. And so it's very important that you calibrate your assessments because they affect both your ability to protect your capital, but also the ability for you to invest your capital. And these are both important, both on the positive and on the downside. So that's how you can make long-term growth rate assumptions. I've now covered how you can make them, what they are, and how to calibrate them based upon management's regulatory disclosures. If you'd like to find out the details about what I believe the intrinsic value for Omnicom is, please consider becoming a patron, and you can do so at DIYinvesting.org/patron or click the link in the show notes. Thank you very much. The full show notes for this episode, including my outline for today's podcast, are available at DIYinvesting.org/episode 25. Thank you for listening, and until next time, stop paying fees, start building wealth.
Thank you for listening to the DIY Investing Podcast. Please visit our website and subscribe to our email list at DIYinvesting.org for guides, videos, and resources to help make you a better investor.
The DIY Investing Podcast is presented for general informational and entertainment purposes only. I have not considered your specific situation or risk profile, and I have not provided investment advice. The information presented on the DIY Investing Podcast should not be construed as investment advice. The views and opinions expressed on the DIY Investing Podcast are those of the participants and do not necessarily reflect those of the show's host or sponsors. DIY Investing, its producers, sponsors, and host, Trey Henniger, shall not be liable for losses resulting from investment decisions based upon information or viewpoints presented on the DIY Investing Podcast.